All right, well, welcome to Chapter 18, where we'll talk a little about shareholders' equity. To speak. Where am I? There we go. So in the types of businesses, we've talked in the past about proprietorships and partnerships, but specifically when we talk about shareholders' equity, we're talking about corporations. So there's the private sector. Typically, they're profit-oriented. There are not-for-profit organizations as well. The not-for-profit organizations, there won't be shares issued, but typically in the profit-oriented, there will be shares of some sort. Some that could be publicly traded, some that might be privately held. Then in the corporation side, there is the public sector, municipalities, crown corporations, healthcare organizations, things like that. Those organizations would typically not have shares as well. Okay, and the type of business, when you're looking at a corporation, they always have limited liability. So any losses that are incurred are limited to any amounts invested into the corporate shares. So it's a separate entity. It helps protect those shareholders. So just some things to remember: equity, assets equals liabilities plus equity. So just a reminder that equity is what the owners own. So the owners of the business, what is attributed to their investment value. Any shares authorized is the number of shares that the board has confirmed in their corporate charter as being allowable volumes of shares. Then there's a term, shares issued. How many issued shares do they have? So how many have they sold to shareholders and that are typically exchanged, whether publicly or privately? And shares outstanding could be different than issued. So they could issue shares, but maybe they've held some back, and there could be fewer outstanding. Then we talk about what are the types of shares. We have common, which represent any residual ownership in the corporation. Okay, so common shares are typically your primary owners. They're the voting individuals, so those that are generally control management through voting rights. Preferred shares are a special class that sometimes and very often don't have voting rights, but they might have preferred rights, such as they could be convertible to other debt instruments or common shares. They could be callable by either party. They could be retractable, which means we can take them back, and they could be participating, and we'll explain more of that throughout today as well. Participating, talking about dividend components. And we need to understand those differences in preferred shares because it impacts how we allocate dividends. So we'll do an exercise on that today as well. When we look at components of equity, often you'll have the original investment for common and preferred shares. Okay, so those initial funds from our shareholders come in, that will be part of our equity section of our balance sheet. And we could have many different types of preferred shares. We'll have retained earnings, which is our accumulation of any earnings over time, less any dividends paid. Okay, so that's the accumulated equity. We could have accumulated other comprehensive income. So just think back of Intermediate Accounting 1 class. So just that's not what this chapter is about, but just remember that that's part of equity. And there could be some certain assets that are revalued. And then you could have contributed surplus. Okay, so thinking back from some of your other courses or the earlier chapters where we have a contributed surplus, say on a convertible bond or share purchase plans, things like that, you could have contributed surplus in your equity section. So when we first issue shares, and that's what we call selling shares, first of all, we need to make sure the shares are authorized. So within our corporate charter, do we have the right to issue those shares? So they've been authorized by our board. Once that's verified, then we would offer them for sale. Any amounts are collected from the sale, and then share certificates are issued. So typically, these are traded on some kind of market that can help track it. If not, you could do this old school, pen and paper, so to speak. Yes, that would happen. No journal entry is recorded when shares are authorized. But when a company sells shares, we will do a journal entry at that point. So either we get cash or assets in exchange for those shares. So watch out for shares with a par value because there could be a contributed surplus component. All right, so when we sell subscribed shares, there are 3 steps that you need to remember. One is we need to record the subscription receivable. We need to record the cash receipts, and then we will record the issuance of the share certificates. All right, so if a subscriber for a subscription share contract defaults, sometimes those funds are refunded, sometimes they're forfeited, and sometimes the shares are issued for what was paid and the balance is canceled. So if they pay a portion of that subscription, but not all of it, maybe we'll give them some shares on behalf. So just, it depends on the situation. So watch out for those journals. Okay, so let's move on to reacquisition, retirement of shares. Sometimes, why would a company do it? So sometimes they want to increase the earnings per share. So if they have forecasted earnings that are, say, fairly flat, but our EPS ratio is fairly low, maybe they want to pull back certain shares in order to increase the EPS, and therefore would increase the return on equity. Sometimes they want to have enough shares on hand to satisfy employee share compensation commitments. So if they have a share option purchase plan and maybe they don't have enough shares available, so they have to buy them back in order to have sufficient volumes to meet employee potential demand. Sometimes it's to minimize potential takeover. Sometimes it's to drive up market price of shares because it drives up demand for shares. Fewer shares, the higher price. And sometimes it's to return cash to shareholders. So just some of the different reasons. Once those shares are reacquired, sometimes they're retired or canceled. Okay, so they have to be taken out of the authorized and unissued. Okay. In most cases, when shares are reacquired, the price paid, as noted here, will be different than the amount that was originally received for the shares. So we need to understand what happens in those situations. So you could have, you paid more, you paid less, or you paid equal to what they initially invested. Let's walk through that. So if we paid more than the original cost, we'll reduce the share capital by the par value or the assigned cost. Any excess will be charged the contributed surplus to the extent that there is a balance. And then any excess will then reduce retained earnings. Okay. If it's less than cost, we'll reduce the share capital by the assigned cost amount and book any difference, the credit to contributed surplus. Okay. So we don't want to overdo the share capital component. All right, so then profit distributions. This is where an organization has made a decision to distribute some of the profit or accumulated earnings back to the shareholders. And this is known as dividends. So we need to make sure that the capital of the organization is maintained intact, so they can't declare dividends to the point that it puts an organization underwater or in trouble. Okay, so we can't declare dividends if we can't pay our liabilities, and if the realizable value of our assets less liabilities is negative. Okay, so they can't go negative to declare dividends. There needs to be formal approval from the board of directors, and any declaration must be in accordance with any contract. So they have to look at all the different classes of shares and make sure that any declared dividends align with those various agreements. All right, so on the cash dividend side, we'll have a declaration. So we declare today that we're going to pay dividends. We need to record the payable. The date of record, there's no entry. Okay, so it's whoever's owns the shares on that date will receive a dividend. So typically you declare, say today, June 20th, that on June 30th, we're going to, as of the date of record, June 30th, we're going to pay a dividend and we're going to pay it on July 15th. So the declaration, the payable, the date of record, you pull your list of owners, and then the date of payment, you'll record the actual payment. Sometimes you could have a dividend in kind where you might receive property or an asset other than cash, and we'll have to look at fair value. So if we're giving out an asset or inventory as a dividend, you need to look at fair value. Sometimes an organization, instead of actually paying out dividends, they could give stock dividends. So it's no assets are distributed. The total shareholders' equity does not change, but a portion of the retained earnings will become part of share capital. So there's a shift from retained earnings over to share capital, and the dividends are recorded at the fair value of the shares. So our journal entries then on the declaration would be debit your dividends, credit your stock dividends distributable. And then when you distribute them, they will reduce the stock dividends distributable, debit, and credit your common share value. Sometimes you might have a stock split. So a stock split is where you want to increase the number of shares, but you don't want to change the share capital or retained earnings amounts. Okay. So that stock split, typically what it does is it drives the average price down on the market, because everybody that has, say, 1 share now has 3 shares. So if it was worth 30 bucks before, it's probably gonna be worth close to, say, $10. So it makes it a more reasonable or achievable investment product. A stock dividend will increase the number of shares. It does increase the share capital, and it does decrease retained earnings like the previous slide. So just to remember those two differences. Moving on about preferred versus common dividends. Who's paid first? Well, it depends on the type of preferred share issued. So what are the details of the preferred share? Are they participating? Are they cumulative? Are they not? So we'll walk through some examples on how that works. And lastly, there'll be some disclosure requirements for the equity section. So how many shares are authorized? How many shares are issued for each class, and what was the amount received? Are the shares par value or not? Do they have unique rights? So can they be converted? Can they be retracted? What's the dividends preferences? You know, who gets paid first? Any changes in the shares and the type of shares issued in the year? And in IFRS, they actually add a statement called the Statement of Changes in Financial Equity. And we need a statement in our notes talking about how it manages its capital. So that's in a brief description of the theory behind it, and then we'll do some exercises.